Well, the Fed's dual mandate is maximum employment and price stability. It isn't officially concerned with keeping investors happy, but every now and again, it will make some moves that give markets a tailwind. Sometimes it's in the form of extra liquidity to keep things moving along. And other times, it's just saying the right things. The central bank is now penciling in 3 rate cuts next year. Investors are running with that narrative, with the street forecasting even more than that. But a so-called Fed put goes further. It's the market's belief that the Fed is going to step in and implement policies to limit the stock market's decline beyond a certain threshold. Our next guest predicting that 2024's Finance Word of the Year is indeed put. So we want to bring him in, talk a little bit more about that. We have Jason Draho, his UBS Head of Asset Allocation for Wealth Management here joining us. Jason, it's great to have you. So the word of the year that you are expecting for 2024 Finance Word of the Year is put. Talk to us about that and why you think it will be so relevant looking ahead to next year.
Well, I think all we have to do is look at the past month or so in the markets to see how just the talk of the Fed, perhaps pulling forward cuts, making now this dovish pivot last week out the FOMC, at least that's the perception, that the markets have rallied strongly. Not only that, you've seen strong inflows in the markets, there's been a rotation. So just a hint of the Fed actually willing to cut, even preemptively, if growth, isn't even slowing, but inflation falls, you see the markets react. So I think the sensitivity of the market to any utterance or data points that would suggest either the Fed does more or less than what the market's expecting, that's going to be the single biggest factor driving markets, certainly in the first part of next year.
Okay, so it's not going to be generative AI. It'll be the Fed. I mean, ultimately, of course, that has, and I joke, I kid there. Sure, generative AI, big story of the year, but it's really been the markets hinging on whatever type of tenor the Fed puts out into there, and ultimately where that propensity for a possible cut has come forward. Based on what your team is looking at and where the best assets to be allocated in are, in the event that we do see an earlier cut and cutting cycle initiate than expected here, where are those areas in those pockets?
So overall, if you look at equity markets in general, they're pricing for a pretty good outcome. I think the prior person commented that the market's expecting significant cuts, yet positive earnings growth, kind of the best of all worlds. That seems unlikely. Everything's going to go quite that well. So from an index level for the S&P, we don't see a huge amount of upside. But at least in the very near term, what we think is, as the market sort of chases this potential Fed put, as you've seen parts of the markets really underperform, small caps are an area that we've liked. I think there's good scope for catch up. Whereas the S&P has already hit, or it's almost at an all-time high again, the Russell 2000 is still about 15% below. As the rotation takes place, even the next month or two, there's good kind of potential for catch-up there. So that's something we like, certainly tactically. But on a little more strategic basis, thinking about the full year, we are concerned that because the markets are pricing in so much good news, that there's scope for disappointment. And the best way to kind of ride it out right now, given the uncertainty of how this will play out, is to buy kind of higher quality stocks. That includes the tech sector that's pulled back a little bit recently, at least underperformed the markets. But I'm talking about companies that have high returns on capital, relatively low leverage, things that can kind of weather and do well in all different scenarios. So it's a bit of I'd say kind of a barbell, take advantage of the cyclical momentum in small caps, but also be prepared for, worse news to come, and therefore, look into quality stocks as well.
So, Jason, it sounds like you think the Fed may be more likely to disappoint investors next year. So making sure you have some defensive plays within the portfolio make a lot of sense. That outperformance, though, that we have seen this year, the fact that the market seems to not really be paying too close attention, or maybe the better way to put this is hearing what it wants to hear. When we talk about that downside risk then for next year, I guess more directly, what does that potentially look like?
Well, I think if the Fed disappoints, it doesn't hike as much or cut as much as the market expects. It probably is because the economic data is holding up reasonably well. So the Fed could disappoint, but the economic data kind of offsets it. So I think for the overall markets, that's more of a kind of a modest story. Where the disappointment could come in, and the real sort of downside surprise is ultimately the lagged effects of monetary policy end up proving to be, they're still there. They've just taken longer to kick in. And before the Fed can really react with those, kind of those cuts, the economy starts to kind of roll over. And I could see a situation then where equity markets will look at this data. You see, say, a payrolls report of 30,000, and you don't know, is that just a bad month, or is that a trend towards kind of negative payrolls growth? So I can see the markets pulling back in that scenario, and even more so if it turns out we get a mild recession, because definitely we're not priced for that at this point in time.
Wow. Okay. So mild recession, is that in the base case right now?
That's not our base case. We think it'll be a softish landing, but thinking about like where could we be wrong? What's the biggest reason we'd be wrong? It's because we're too confident on growth. The economy would slip into recession. That's not our base case, but that to me is like the number one risk case out there that we can at least kind of have some sort of confidence in saying that's an obvious case. Things like geopolitics, that's really hard to kind of calibrate with any confidence the probability of something like that happening.
Yeah, we were just talking with Nathan Sheets about that a moment ago as well. Jason, thanks so much for taking the time. Jason Draho, who is the UBS head of asset allocation. Appreciate the time.
You're welcome.